Welcome to everyone. Thank you for joining the Maner Costerisan Consolidated Appropriations Act Q&A. This is the second one we've done for this round. If you were around over the springtime, we did many of these as well, just trying to make sure that we make ourselves available for all of our clients and people throughout the community, actually, to make sure we get the questions answered. We understand that there's so many organizations, nonprofits and for-profits, that have just had such a tough time right now. We want to make sure that we can be good resources in any way possible, especially in this virtual world. My name is Sarah Jennings. I am a partner in the Accounting and Outsourced Solutions Department. Joining me today, as they were last week, are Jim McNeely, the Department Head for Accounting and Outsourced Solutions, and Shane Obie with our Tax Department. We were talking over this, and we like to kick it off with anything new or anything that has been kind of a revelation around. We felt like we were learning new things every single day. But over the last week, there hasn't been tons that has really been, monumental interpretations or FAQs that have been released. We're going to go, Shane and Jim both chat for a little bit. We're going to go over some of the things that we have kind of brought together. It might not be new interpretations, but it's just different ways of looking at things and things we really want to make sure that people know about. Jim, I'll let you go first. I will share my screen and just go over some of the things, big picture things to consider, just to do kind of a global perspective of what to consider with all this new legislation. I will share my screen real quick now. And as I do this, I do want to make sure that everybody on the call can see my screen. We have been hard to put additional resources right out on our website. Things have been changing so frequently. We try to, instead of having static PDF documents that we're sending out to people, we're trying to update this on a regular basis. So a couple of things that Shane and Jim are going to go over in here. The first one, Jim is going to go over this just at a glance, big picture. What are some things that we could think about? Jim?
Thank you, Sarah. I appreciate that. For those who are on the call that weren't last time, and for just to hit it home again for those who are doing this again. So in December, big laws passed, and it's updates to the Paycheck Protection Program and updates to the Employee Retention Credit. Neither one of those are brand new programs, but the changes they've made have really re-energized the program to the point where they're like new programs. The Employer Retention Credit, before the update to law in December, was only available to people who didn't get a PPP loan back in earlier in 2020. And so with this law change, it opened up the Employee Retention Credit to people who did get Paycheck Protection Program loans in 2020. And the amount that you can actually get in these employee retention credits is pretty big. It's huge. It's not something that you have to apply for and hope that you get. It's something that you review your information and your documents and determine your eligibility, and then you simply take the credit on your 941. So that's been huge. The Paycheck Protection Program was opened up for a second round. So people who got the Paycheck Protection Program loan in 2020, now meeting certain criteria, can apply for a second draw in 2021. And it also opened up to people who were previously not qualified in 2020 to the 501c6 organizations. They're now eligible to draw from these PPP loan funds, and where they weren't before. But those are the big things, and a lot of that is in here. There's obviously tons of questions everybody's got, very specific to their circumstance. We're going to do our best to hit all of those questions, and then any specifics we're happy to address afterwards as well.
Absolutely. Thank you, Jim. And yeah, this isn't a big picture at a glance. Oftentimes we start the conversation and it actually ends up being more questions rather than answering things when we have a document like this that I've shown. or that Jim has just gone over. But we really wanted to capture, at least from our perspective, the high points that clients should really be making sure that they're taking a look at. Again, I'm going to let Shane go and just talk about some of the different things with the employee retention credit, in particular, when you're looking backwards to say the 2020 piece of the employee retention credit, how could that potentially impact me now? We do have kind of a workflow or a decision tree here on our website that he is going to go over to make sure that your appropriate considerations. Continue to put your questions in either the chat or the Q&A. And as soon as Shane gets done with this overview, then we will get started on the Q&A. Thank you.
Thanks, Sarah. To answer, I did see one of the questions, how do we access this? If you go to manercpa.com, there should be a COVID-19 resources tab on the very front page of the website. If you click right there, it'll take you to a link to all of these different resources that we have up. But to go into the employee retention credit, this chart is really just looking at 2020. It doesn't factor in 2021. So the Act, you determine your eligibility for a specific quarter for either 2020 or 2021. They're independent. If you get it for 2020, you might or might not get it for 2021 and vice versa. So if you're looking at this, just know that it's specifically referring to 2020. So the employee retention credit was made retroactive for PPP borrowers. So that's why we're starting to consider this now, as opposed to when it first came out with the CARES Act, because a lot of you that are on here are PPP recipients and originally wouldn't have been able to get this, but now you can. So the Act allows you to get a 50% credit up to 10,000 of eligible wages for a maximum of a $5,000 tax credit per employee. So do you qualify? That first box is you have to meet either requirement A or B, not both, just one. So the first requirement is, was your business shut down due to government order? This can be either a full or partial shutdown with no ability to work remotely. If you meet that, you qualify. The second condition, condition B, is did your business experience a 50% reduction in gross receipts for 2020 quarters 2, 3, or 4 compared to the corresponding 2019 quarter? So what that's saying is if you compare your gross receipts from quarter 2 of 2020 to quarter 2 of 2019, did they fall by 50% or more? If you meet that requirement, you also qualify. So if you go down the yes option there, you'll see right there, you qualify for the ERC. So depending on which of those two situations that you meet, different time periods would be eligible. So if you met requirement A, only the wages and group healthcare costs while shut down are eligible for the ERC. Whereas if you met B, all wages and group healthcare costs for that quarter and through the end of the quarters until business receipts return to 80% of the corresponding 2019 quarter are eligible for the ERC. So that's a little wordy. I think it'd probably be easier to give an example to explain it. If you're eligible in quarter 2 of 2020 because gross receipts have fallen by 50% or more compared to quarter 2 of 2019, quarter 3 would automatically be eligible. You essentially get a free quarter because it goes through the end of the quarter that gross receipts rise back up to 80% of that 2019 quarter. So if you get to 85% of the 2019 receipts in that 2020 quarter, that quarter would be eligible, but the next one would not. If it's still below that 80% of the 2019 gross receipts, you would have that quarter and then the following quarter, regardless of if it meets that 80% requirement. So you essentially get a free quarter. You might get 2 if you don't get up to that 80% in the second quarter that you're checking. So again, going down to the next box, do you have 100 or less average monthly full-time equivalent employees? And that amount is looking at 2019, not currently in 2020. If you did, that's good because all of the wages that were previously eligible, either for the time that you were shut down, if you met that requirement, or for the entire quarter, if you met the revenue reduction requirement, all of those wages can be used to get up to that 10,000 maximum wages per employee. If you had over 100 employees, it gets a little bit more restricted on which wages or healthcare costs you can use towards that 10,000 maximum. It can only be for services, or sorry, it can only be for wages provided to employees to not provide services. So to kind of explain that in common terms, I would say that if you had furloughed an employee and you kept paying them, or you provided healthcare costs to that employee, then those would count as wages to not provide services. But if people were still coming into the office and doing something, or they were working in an administrative role and were still getting paid for that, that would not be considered wages to not provide services. So those wages would not be eligible for the ERC calculation. So if you jump over to that left box over by the calendar, it's going to say, does your PPP loan covered period overlap any employee retention credit eligible quarters? That would be if you met that requirement, or the shutdown again, and your loan covered period if they were at the same time. So if they do overlap, you would have some wages to potentially shift over to the employee retention credit, as opposed to using them for Paycheck Protection Program forgiveness. The idea here is that we would want to maximize non-payroll costs on your PPP forgiveness, being able to reserve those wages for the employee retention credit calculation. You can still receive full forgiveness if you get up to 40% of non-payroll costs. So there's a 60% payroll requirement for PPP forgiveness that you would have to reach to still get full PPP forgiveness. But you could use those other 40% of non-payroll costs to still get the maximum. That way you could maximize employee retention credit and the PPP credit. I feel like that might have been a little unclear, so I'll try to simplify it a little bit. If you have wages that you're considering using for either the employee retention credit or the PPP loan forgiveness, you need to use at least 60% of those for PPP forgiveness, because that would be more beneficial as opposed to the payroll credit here. But you would try to shift as much as you could away while still meeting that 60% requirement. So you could maximize both PPP forgiveness and the employee retention credit. So if you see where all of these nodes end up leading you to, you can apply for PPP forgiveness using your payroll costs. We recommend that because regardless of what other costs you use, you still have to provide the payroll documentation and those costs anyway. This is just a much simplified and easier way to apply for forgiveness using the payroll costs. If you have any questions about that, feel free to contact Maner and hopefully we can answer it. That's a high level overview, but hopefully this chart will give you an idea of if that's something that you should consider.
Thank you very much, Shane. It is hard to explain that just verbally. So I think this flow chart that you actually created, and we thank you for that, but this flow chart and decision tree really helps people put it into perspective. I'm going to stop sharing now, and I will go ahead and put the links to our COVID impact page in the chat so everybody has them. Everything that was just gone over between Jim and Shane is right on those, right on that page as well. So then as I said, we did get quite a few questions in beforehand. People, thank you very much, are putting them as we go. So I am going to start with some of the ones that we got in beforehand, just to make sure that we get those as well, and then we will continue on. Just keep putting in all of your questions there. We definitely appreciate it, and we will try to answer things pretty concisely so that we can get through everything. So the first question that we've got, and I think, Shane, you and I had talked about this just yesterday. How do independent contractors with employees apply for the PPP program? Is there any relief for them?
There are. So you would use your Schedule C from your Form 1040, and then also payroll costs. So just to give you an idea of how it would be calculated, you would take your net income from Schedule C up to $100,000 plus those payroll costs for the year. You would divide all of those by 12 to give your average monthly cost, and then multiply that by 2.5 to get your maximum loan amount.
Perfect. That is a question that I think we've gotten quite a lot, actually, and kind of along that line. So another question that we've gotten, we have a lot of clients that either are management companies or maybe they're managed by a management company. They're wondering what relief or what help is there out there for them. And one of the questions that stems from that really is, well, can I just put my independent contractors on my payroll now, make them employees? Jim, could you go into a little bit of detail as to why it's not just a flip that you can just, or a switch that you can just flip on or off? There are some rules around that.
Sure, Sarah, thank you. So this question actually comes up outside of out of this format as well. Very often is people ask, can I put either can I move an employee to an independent contractor state, or they're trying to make a decision on whether they want to add them to payroll or make them an independent contractor. And my response is always, it's not a decision that you make. It is a facts and circumstances on whether they are an employee or whether they are an independent contractor. So the IRS has a full list of rules that you have to follow, or determinations to help you understand how it should be classified. But misclassification of a independent contractor or an employee is by definition an IRS issue. So it's not a decision, and you can't just choose to put people on or off payroll. It's the facts and circumstances of whether they meet the definition of an employee. And if they meet the definition of an employee, then they should be employees, and you shouldn't list them as independent contractors. And the same the other way. If they are truly independent contractors, then you should not add them to your payroll.
And one of the things that we had prepared a couple of years ago, actually, because you're right, this isn't a question that's just on the PPP. It is something that we've had to deal with for years. And a couple of years ago, actually, the IRS was doing some more audits on this, independent contractor versus employee. So we have, and we can post it on our website as well, just kind of a little checklist that we were recommending to clients, just put in their file. If you do get audited and the IRS sees you went through all of the different considerations, independent contractor versus employee, there are absolutely some gray areas. But if you at least prove out that you've considered everything, that you're doing your best to make the correct decision, then that'll help you in the event of any audit. So we'll put that on our website just as a resource as well. The next question, Jim, is also to you, and it's really a follow-up on that, on the PPP fund. So now we've determined that we are eligible for a PPP fund. How do you determine how much the maximum loan amount will be?
That's a great question. And the answer, in so many cases, it depends. So the answer, the general easy answer is, if you received a PPP loan, draw one, last year, you have the option of using the same measure to determine your second PPP loan. So if you used 2019 payroll to determine your PPP loan for your first draw, then you can simply use those same documents and get the same draw for your PPP loan second draw. So it's really, you can be the same period, or you can utilize 2020 and recalculate based on 2020. But most people had more payroll in 2019 and just will be utilizing the same documents.
Perfect, thank you. Another question, Shane, this was a new question posted today, but related to the reporting. Is the $100 threshold a combination of both loans together or each loan individually when we're looking at first draw, second draw, I believe is what they're referring to?
Can you say the first part of that? You cut out for a second.
I'm sorry about that. The $150,000 threshold, is that, when you're looking at that, is that just the current PPP application? It's not a combination. If you got PPP 1 and PPP 2, it's not the total of the two. It's just one by one, correct?
Correct. It's a little, well, there's different things regarding the $150,000 limit. For the first round, it's going to be a much simplified forgiveness form that we should be getting any day here now, to where it's just going to be a one-page certification. You won't have to do any of the calculations. And then if you're applying for a new loan that's $150,000 or less, you won't have to provide documentation of the revenue requirement until you're actually going to apply for forgiveness for that.
Perfect.
But those are considered
Thank you very
independent of each other.
Correct. Yep. I think that was the question. If we didn't answer, if that wasn't the intent of the question, please type in another one. The next question that we've got is also related to the PPP. Are you able to report less employees on the second round if your employee count has been reduced since the first round was spent forgiven? Shane, what is that comment or what is the answer from your perspective?
I would say, yes, you can. You need to report accurately on the application of how many employees you have when you're applying. They haven't released provisions for forgiveness yet for this second round, what actual employment periods they will look at. But being consistent with the first round of how it was applied, you most likely will just need to maintain employment levels from either now till the end of the covered period, or potentially the reference period of when you had applied. But I would say a general rule of thumb is if you maintain your employment levels and your payment levels, then you should be okay and you wouldn't have to worry about forgiveness reduction.
Perfect. Thank you very much. The next one, Jim, is a pretty specific question that we received in advance. Our TV stations have actually experienced increased revenue during the coronavirus. However, it's due to the political season and obviously probably some things with the additional news we reported because of the virus. However, it's due to those things, and it is masking or covering up the huge reduction in traditional sources of revenue like the local, national, and regional ad sales. Does that prevent them from benefiting from the second round of the Paycheck Protection Program?
So I appreciate that question. Now that question can actually be extrapolated into a number of different situations. So I've received a lot of questions that people are comparing results in 2020 to a normal year and saying, well, I received these receipts, but they're not really related to my normal operations. So the rules on this are actually, they're pretty clear. They're very clear. They're your gross receipts take into account for 2020 when you're doing the comparison. It's any gross receipts that you've received from any of your locations and for any of your normal or for any regular operations. If you combined through like a merger, or you separated due to a merger out, then you can exclude or include those in the comparative period. But if you add a location, or if you get additional revenue for a special project, you have to include that just as it is on your financial statements.
Right. It seems like you should be able to separate that out, but I know that's a huge question for people. It's unfortunate, but that is the way of the PPP. There are, that said, some provisions within the employee retention credit, maybe not for this example, but when you do separate out your partial closure, things that weren't allowed to happen. And one of the examples I think we had talked about is a golf course, right? So for the ERC, not for the Paycheck Protection Program, but Jim, for the ERC, if we're talking about a golf course that has banquet facilities and greens fees and all of those things, we could potentially say it's at least a partial shutdown. Is that correct?
Yes, that's correct. So the partial shutdown provision for the ERC is really, I mean, an awful lot of companies were partially shut down for 2020. So in partially shut down, right from the word partially, it can be a portion of your business that was shut down, or it can be if the whole business was restricted. You know, a lot of times restaurants are asking this because they're like, well, my drive-through's been open the whole time, but we haven't been able to have indoor dining. And so, yeah, that's a partial shutdown. If your indoor dining was incidental, like you had a couple chairs, but you didn't really have indoor dining, then that's not a partial shutdown. If you were, you know, so, but in that type of an organization, yes, if the banquet was shut down, but you were still able to have green fees, it's still a partial shutdown. So you may have, you may be eligible for the employee retention credit.
Perfect, thank you. Shane, the next question we had that was submitted early is, how does my EIDL advance or grant impact the Paycheck Protection Program forgiveness?
So the Stimulus Act actually made it to where those no longer impact your Paycheck Protection Program forgiveness. Previously, whatever your EIDL advance was would be taken out of the amount that was forgiven. If you have already applied for forgiveness and received it, but got the reduced forgiveness due to the EIDL advance, you will be entitled to automatically, you don't have to fill out any forms, you'll get that amount back plus any interest automatically. So seems kind of weird since forgiveness isn't actually a payment, you'd already gotten the loan. What that's saying is if you had been making payments on that advance, then you'll get those payments back with interest because that amount should have been forgiven.
Right, exactly. That was one of those things that even, last April, May, we were going back and forth. Well, that wasn't the intent. Why would they not provide forgiveness? These are two separate things. So it was good to see clarification on that. Jim, the next one we have is, this is specifically actually to the SOS grant, but are there any grants included in the latest release bills that will make a company ineligible for the employee retention credit?
Easy answer is no. Grants do not, they do not cause you to be ineligible for the employee retention credit. The big thing, and I know I said it a lot last time, I'm going to say it again, is no double dipping. You can't double dip. So if you're using payroll for the PPP, or you're using payroll for a grant, or for any particular credit or grant, then you can't use that same payroll to also get the employee retention credit. But I know that we're going to also talk about some strategies on maximizing employee retention credit as well. So that's coming up.
Yep, and Shane did mention some of that at the beginning, but yes, we will definitely be going over that. I'm going to go back to some of the questions submitted today. Shane, we had talked about this in the most recent FAQ come out, just additional clarification on what support you have to provide that you were in business prior to February of last year. So the question here is, does the business have to have been in operation prior to the pandemic?
As long as you're in service on February 15th of 2020, that's their cutoff date. So if you're operating by February 15th of 2020, you're good to go. They do require documentation for that. It's a little bit different from the first round. So you should just submit a payroll report showing that you were in operations on February 15th of 2020. Some other additional documentation that you didn't have to have last time would be that revenue reduction requirement for loans over $150,000. If you provide financial statements that are not audited, you will need to sign the first page and also date the first page. And then you will also need to initial all of the remaining pages.
Perfect. Thank you. And a second part to that question, I think Jim just spoke about, but does a partial closing count as a shutdown? And I think, as I said, I think Jim did a great job going over that. There is some guidance specifically related to the employee retention credit defining what a partial and a full shutdown is, a website, and I'll try to get that in our chat log as well. The next question is from Amy. Jim, do we look at calendar quarters or fiscal year quarters when we're looking at some of the options?
It's calendar quarters. So it'd be the January, February, March is quarter one. I'll let you do the math through the rest of it, but they're the calendar quarters.
Perfect. Give you all the real short questions or
Thanks.
short answers, I guess. Shane, the next one, Jim was just alluding to, and I think this will be a good conversation next of you, but can you qualify for the PPP loan and utilize the payroll tax credit at the same time? And I think if we could just expand on how to make sure that we're maximizing both opportunities for our clients out there.
Definitely. So you can be eligible at the same time, but like Jim said, there's no double dipping. You can only use the wage or a singular set of wages for either the employee retention credit or the Paycheck Protection Program. So I saw a question earlier asking, what if we had already applied for forgiveness and had used 80% of payroll costs? Unfortunately, you won't be able to substitute those non-payroll costs into your payroll or your PPP application. But what you can do is if you have excess payroll over the loan amount. So to give an example, your loan was $100,000, but you provided 24 weeks of payroll expenses showing that you had $150,000 worth of payroll. Since you only needed $100,000 worth of payroll to get that PPP loan fully forgiven, you could take that other $50,000 if it's in an eligible time period for the employee retention credit and use those wages there, because you still have enough payroll to support full loan forgiveness. It's just the excess amount over that. So hopefully that cleared that up. But if you haven't applied for forgiveness, that's where the shifting the funds around kind of comes into play that I was mentioning earlier.
Just to add on to that, Shane, I think that's a great point. Sometimes my brain works a little bit differently, as you know, than other people. But the way it became really clear to me is that I was looking at the employee retention credit and saying, okay, well, we can go back to March 17th or whatever. But as soon as you got your PPP, now you're using all those wages for the PPP. But if you actually realize that the wages are over a 24-week period, so basically 6 months, oftentimes in most of the forgiveness applications, we're way over in wages of what we need to get full forgiveness. So instead of thinking that the wages start on the day you got the PPP loan, just think that it's wages during that whole period. So if you shift all those wages towards the end of your covered period, then there may be a bunch of wages at the beginning when you meet the qualifications for the employer retention credit. So you may actually be able to just kind of look at shortening the wages that you're using for the PPP loan. And so that may have been more confusing for other people. That's just kind of visually how I saw it in my head. So there may be quite a bit of credit available for a number of people.
No, I think that this is an important topic, and we've talked about this. That's one of the reasons we made that extra flow chart, because this is an opportunity that's retroactive to make sure our clients don't miss out on. Obviously, the 2021 credits are even more beneficial, but if you add up a max of $5,000 per employee or credit of $5,000 per employee for 2020, that can definitely be some real benefit to people. So thank you for reiterating that. Shane, this is the question that just came in today. If we do not have our quarter 4 941 for 2020 yet, just because it hasn't been completed yet, can we still use 2020 for the payroll calculation?
Yes, you can. You would need to still substantiate that payroll information, though, either with a third-party payroll report, or if you had your W-2s or W-3 for the year. That could work as well. You don't necessarily have to use the 941. With that being said, though, it does come down to the individual who's reviewing your loan application at the lending institution. So it might be worth providing a note saying that you don't have that quarter 4 941 available yet. So that's the documentation that you do have. Some of the times they can be strict about having the 941, but ultimately, as long as you still document those expenses, you should be good to go.
That's a really great point. So some of your initial applications, obviously, eventually it's going to get to the SBA, but it goes through underwriting at your normal financial institution or your lender first. So they have their own quality control and their procedures that are only going to be more stringent than anything that the SBA puts out. So that's definitely something to think about. Jim, the next one I have for you, for those who took PPP loans and now are newly eligible for the employee retention credit, and now they're requesting that refund on their fourth quarter because they're going backwards. How long do you think the IRS will take to send those checks?
Thank you for giving me this question.
You're welcome.
I'm going to answer that with probably a long time. It's going to take several weeks, and those weeks will probably be a couple months. Based on the correspondence times that we've seen with the IRS and the processing times, it's going to be several weeks. So I don't have a good answer, other than it's going to be a while.
I want to add on to that just a little bit. I had heard from a client earlier this week that had applied for the employee retention credit back for their quarter 2 941, and they still haven't received that refund check yet from quarter 2. So it's definitely taking a while to get those back.
Yes, that is what we are hearing, unfortunately. So Shane, the next one, I do want to go back to this before we get too far away from the conversation about the employee retention credit and how to maximize. So this is a specific question. This is an example. So we used 80% of the PPP funds, so this is round 1 for payroll, and already received their forgiveness. But now, because they can retroactively apply this employee retention credit, and we know that the 40% has expanded what's allowable in that 40%, the 60% max payroll or threshold for payroll to get fully forgiven, 40% is now expanded. Can they retroactively go back and say, well, we only want to use 60% of our payroll. We have enough expenses in the 40% to cover it?
So unfortunately, no. What Jim and I were saying earlier about shifting around the payroll, that's because you had still submitted documentation to the SBA to substantiate the amount to get full forgiveness. You can't just go and start changing which expenses you want to plug in because they wouldn't have documentation on that amount. So you couldn't necessarily use it. The payroll that we were going to shift to the employer retention credit is just the excess over what amount would have been needed to reach full forgiveness. But the SBA still had all that documentation and had approved that already. So you can move that around because they had approved all of those expenses that were there. You just happen to have some excess that weren't needed for the PPP forgiveness.
Right. That was we had a lot of clients who we were trying to accommodate everybody and get forgiveness applications submitted as quickly as possible. The part that, we better slow down because there were so many questions still out there on the forgiveness side of things. Speaking of that, obviously we know when the last legislation came out, they clarified that all of the expenses that are forgiven are fully deductible. The revenue or the grants that you get from the PPP funding is not taxable. One of the questions we received is Michigan going to be following the IRS in all of this, or do you see any changes in that, Shane?
I haven't seen anything clear saying that they wouldn't be following it. Generally, the states comply with whatever the federal taxing rules are. So I do not believe that would be counted into gross revenue. If we see anything that changes, we will definitely make that known because that would be a pretty big surprise. But I would not expect that to be included as of now.
Perfect. Thank you. So I do have a rewording of a question when we were talking about the $150,000 threshold. So is the threshold to complete the simplified form a combination of both loans or individually separate? Clarifying our previous question.
They're individually separate. I've also been asked if you can apply for your first and your second round PPP loan on the same form. Each individual loan will need to have its own individual forgiveness application. So those dollar thresholds will apply to your individual loans.
Perfect. Next question, Jim, this is for you. I know that our department, the Accounting and Outsourced Solutions Department, has had a lot of this trying to mend the differences in the payroll that's been used for Paycheck Protection Forgiveness, some that's used for ERC. So how do you separate the employee wages? How do you document that separation from employees who are used in PPP versus non-PPP wages?
So the IRS doesn't require you to provide documentation, but it's an internal review and examination and determination of what wages are eligible for the employee retention credit versus what you've already used for the PPP loan. It's just internal documentation. It's notes. It's I would say very clear documentation so that you can substantiate that in the event that you are audited by the SBA or the IRS for the employee retention credit.
Perfect. And a follow-up to that, for example, and this I think is the easier situation actually to show. So if your PPP ended in November and then you continue to pay employees in December, absolutely those December wages can be utilized for the ERC. Again, making sure that you're looking at your quarters, if you had the gross receipts reduction or if you were fully or partially shut down. What Jim was just mentioning is there are some instances where it was even earlier on. So it's not like your PPP is done yet. You just need to be able to document those two things in the case of an audit. Shane, the next question is for you related to the gross receipts testing. For both ERC and PP, what basis of accounting is utilized or should you utilize?
You should do whatever your tax basis is or whatever basis you use for tax reporting. So if on your tax returns you use the accrual basis, gross receipts would be determined using the accrual basis, and then vice versa. If you use the cash basis on tax returns, you should use the cash basis here as well. It needs to be consistent for both 2019 and 2020. So you can't use accrual for one and then cash for the other. You got to pick one and stick to it. And generally that should be whatever is shown on your tax returns.
The challenge, and we were talking about this a little bit earlier, is we've got lots of clients that report on a tax return or at a fiscal year end or something on the accrual basis, but throughout the year, it's a cash basis of accounting. So that would be probably an instance where you might actually use the bank statements, even though you report on, because it would be very difficult to go back and do all of that accounting work to try to figure out what your accrual quarterly gross receipts were. Another question related to the PPP. So we're back to the employee count, the FTE count. So back to less employees for PPP, wouldn't you have to use less FTE numbers in the application for PPP too? In other words, you still have to maintain accurate FTE levels from application time through the loan period, correct? Shane, maybe expand on just what the application is asking for. So on that page 1 of your application, it's asking for the employee count as of the day you submit the application, correct?
Correct. So that number is what you have currently employed. What I have advised and have done is to just print the most recent payroll report that you have showing the amount of employees. And that's a physical head count. That's not actually an FTE count. So if you have 4 part-time employees, that would count as 4 for that box there. Whereas the FTE count, you would have to factor in their hours, and it gets a little bit more complicated. So you will have to maintain the FTE count from the application date until the end of the covered period, assuming that they keep those requirements consistent with the first round. But for the application itself, you won't need to do an FTE calculation just yet.
Perfect. And this is a follow-up, I think. I'm not sure if it's the same person, but same subject. I used the number of employees on my second round PPP application that they had before the pandemic started. Should I now attempt to correct that since they have fewer employees now? So it sounds like that page 1, they put in the wrong number. They put in a historical number.
If they're referencing, I think they're referring to on the forgiveness application where it shows how many employees do we have when applying at the time of forgiveness. If that's the case, then if you've already submitted it at this point, if you should probably just wait to hear back from your lending institution, because those numbers, they don't really impact the forgiveness amount, since those are just the head counts. The FTE counts are what do impact the forgiveness calculations. I would wait to see if that causes any concern from the lending institution, but I would have a document prepared and ready explaining why the mistake was made and what it should have said. So if it does get bounced back to you, you can hopefully give them the answers that they're looking for pretty quickly and resolve the issue.
Perfect. And this is actually on the second round PPP application. So I think what they did is when they were filling out that second draw, they put on that front page, maybe they only have 15 today, but last year before in February, they had 20. So they went ahead and put 20 there.
Okay, then yes, I would correct it to what it is now. There's a good chance that the application hasn't been processed by the bank yet. So I would try to get in contact with them and let them know that you had made a mistake and need to go back and correct that.
Perfect. Thank you very much. Jim, the next question we've got is, can you apply for PPP2 funds, so a second draw before your original PPP forgiveness is applied for?
Yes. So you can, the wording is that you either have spent or will spend all of your draw one unqualified expenses, but you don't have to have already applied for forgiveness.
And that's by the date you receive the funds, correct? I think it's when the funds are deposited into your account, not when you're submitting the second application necessarily. The next question, this is the clarification of the question when we were talking about when to be open. So Shane, related to the ERC, can you go into the requirements when they had to be open for business? If they're a new organization in 2020, what are the rules there? Can they still qualify for the employee retention credit?
They can apply, they just have to be able to show the reduction. It kind of varies on a case-by-case basis of when you actually started being in operation. The general rule of thumb is if you have a start date, if you're in operations for the third or fourth quarter of 2019, you would compare your gross receipts to those quarters for any quarter of 2020. If you weren't in operations at all for 2019, you would compare quarters 2, 3, and 4 to quarter 1 of 2020. You still would need to show either that gross receipts reduction or be fully or partially shut down.
Perfect. Thank you. I know that was a question that we dealt with early on. So here's a question clarifying the gross receipts question. So wouldn't you need to use accrual and correct revenue recognition rules for gross receipts, even if it's difficult for the ERC using cash versus accrual? So I do want to clarify, we're certainly not advocating getting around the system, but I do feel confident in that even if you are a nonprofit, and Jim and Shane certainly correct me if I'm wrong, but if you are a nonprofit that gets an audit every year, for example, and your auditors help you get your books into a GAAP basis accounting because that's what you report on, but you've got bank statements from this 2020 and 2019 that support that your gross receipts went down 50%, that would be adequate support to provide for maintain on hand for the employee retention credit. Is that correct?
Yeah, I believe so. Shane?
Yeah,
I mean, the best practice absolutely is going with the same basis of accounting as you report your year end, but in all cases that may not be practical to do so. So I feel like that was them giving kind of a practicality check.
That's correct. You are supposed to use whatever your tax basis is unless you choose to use the bank statements. That's it's a little weird that they do have that in place, but you are allowed to use the bank statements, and that would have to be on cash basis. So it does kind of give you a little bit of an option there.
Perfect. The next question is related to overlap of the ERC and the PPP. So can you claim the employee retention credits on a partial quarters if the ERC or the quarter overlaps the start and end date for your PPP? Jim, want to take that one?
If I understand that correct, yes, the measure of drop in gross receipts or the measure of was I partially shut down applies to the whole quarter, but you just use the payroll for the, no double dipping. So you just use the payroll that's not being used elsewhere, for the credit. So an example, second quarter starts, you've been partially shut down last year. And so beginning in April, you're at 50% gross receipts or partially shut down. You're partially shut down, but you don't get your PPP loan until mid to late April. So yes, those payroll costs would be eligible for the employee retention credit. And then as we talked about other planning options, if you don't, it's not necessarily stopping when you got your loan, because if you had enough payroll costs throughout the covered period, you may be able to shift those payroll costs towards the end of your covered period and open up more of those payroll costs at the beginning that would be eligible for the employee retention credit.
Perfect. Thank you very much. The next question we've got, and this, Shane, is a follow-up example actually from the ERC new business. So if the business is new, it started employing people in September of 2020, so third quarter just starting, and was subsequently shut down or even started at a reduced allowable capacity, can you apply for the ERC for the fourth quarter of 2020?
You would have to be able to show the full or partial shutdown because you wouldn't be able to meet the gross receipts requirements. I don't believe the February 15th, 2020 date is applicable to the employee retention credit. I think anyone is eligible if they meet those two, but you guys can correct me if I'm wrong there.
I believe that's correct.
No, I agree. Yep. Next question is, thank you very much, Shane. We are a restaurant in Michigan with drive-through open the entire pandemic, and the lobby's been closed for most of 2020 because of orders, executive orders. We used PPP-1 funds for an 8-week period early in the pandemic, April through June, and it's been fully forgiven already. Do we still qualify for the ERC for the shutdown period that doesn't fall in the 8-week period already covered by the PPP?
If I understand that question correctly, yes.
Yes.
So
yes.
It goes back to that same, as long as you're not double dipping on the wages, and if that quarter was, the period was partially shut down, if that quarter was partially shut down, then yes, wages that were not covered by the PPP loan would be eligible for employee retention.
Perfect. And then the follow-up to this is, and this is true even if business got better in the second half of the year, so they don't have that 50% loss. But again, if you go back to Shane's kind of decision tree, it's either or. It's not you have to be shut down and have a 50% gross receipts loss. It's either or.
Right. So the partial shutdown is just while you're partially shut down. So if you're partially shut down for the second quarter, then you have second quarter to look at for ERC. If you meet the 50% gross receipts reduction in second quarter, then like Shane said, you get bonus next quarter, third quarter that you can also look at. But it doesn't matter if you were only partially shut down in the second quarter and business was good, then you can use second quarter, but it doesn't matter if the end of the year revenue was way up or anything.
Perfect. Thank you very much. A clarification thing that came to mind, that was all related to the employee retention credit. So for people that are going for their second draw for the PPP, and they have to prove out that reduction in gross receipts, and they can do it. We were talking about the certification, that sure people understand that they're still signing this certification. Shane, can you go into a little bit of just guidance and what people are really signing away when they test the test that they do need the money?
So the first time around, the wording was that economic uncertainty makes this loan necessary to continue business. It's a little bit different this time. I can't remember the exact words, but it's essentially along the same lines. Just, do you need this money to keep your business going? If you weren't getting this loan, would you be going out of business? So when you sign that certification, since you have to put in that revenue reduction documentation, if you put that in your gross receipts for the entire year are very similar or better than what they were compared to 2019, or if your net income for the year of 2020 is better than it was in 2019, it's going to be pretty difficult to say that, yes, we really need this. The economic uncertainty of the COVID-19 impacts are putting our business in jeopardy, because last time there was a lot more uncertainty, whereas this time you almost know what to expect a little bit with how you're going to be able to handle the shutdowns and all the implications of the COVID-19 restrictions. So you really do need to consider if you actually need this loan, or if you're just getting it because everyone wants free money, essentially. You're putting yourself at risk if you don't need it and they come back potentially for fraud, which could lead to fines and jail time. So while free money would be nice, it's not worth risking jail time or the fines and then having to return it anyway if you don't actually meet that necessity requirement.
Following up on that, so if you decide that you don't need the funds after you've already received, I know in the first round, we had some people kind of giving money back. There were no penalties, kind of no questions asked if you give it back. Is there anything similar to that this time around? If you apply for it, you get the PPP2, you don't have use for all of those. Jim, are there any fines or anything that you foresee or have heard?
They haven't specifically addressed that yet, but I would absolutely, if you realize, yeah, I really don't need this and it's not worth the risk, it probably shouldn't. I probably shouldn't have gotten it. Then I would return it. At this point, because there hasn't been a lot of guidance, I'm assuming that they're just going to take it back and be done with it.
We had some of those same questions in the nonprofit realm because there's so many grant opportunities right now, and they don't know if they're getting them or not. So their concern was, well, if I apply for it and then I get another grant that I didn't get, or wasn't even, the application period wasn't open yet, what do I do? And that has been our guidance. Well, if you end up not needing it, give it back. You just have to be completely transparent. If I don't anticipate anybody coming down on an organization that says, oh my gosh, I had this influx of money, here's the PPP funds back, I don't anticipate that, you're getting a big fine for that. We've got just a few minutes left, so I have a couple questions that we wanted to make sure that we covered. One related to restaurants. Restaurants were exempt from FTE count in round one. Will that be the same in round two? Shane, have you done any of the restaurant work?
I have, and I don't recall seeing anywhere that restaurants were exempt from the FTE count in round one. What I would imagine that this question is referencing is if you're eligible to fill out the easy form, you won't have to consider FTE requirements. It's just the costs at their face value. Since the restaurants were especially affected by COVID-19, one of the requirements to be able to fill out that form is that your business was impacted during the covered period due to COVID-19 shutdowns. As long as you had that one, that would apply to all restaurants. As long as you maintained the wage levels of the employees that you did keep on, you were eligible for the easy form and the FTE count wouldn't come into play. So while I don't think it was specifically waiving the requirement for restaurants, in essence, it didn't really necessarily apply to them as long as they did maintain their wage numbers, which I would expect that to continue this time as well. Again, they haven't released full details for the second round forgiveness yet. I think they're going to wait until we actually get closer to the time of people applying for that second round forgiveness. But I would imagine that those same requirements to fill out an easy form would be in there again.
And then I'm not sure if we addressed this in today's session, but the calculation for a restaurant or food service establishment is a bit different for the max loans. You can get 3.5 times as opposed to that 2.5 times of your average monthly salary. Very, very basic way to put that, but that is one benefit. I know that isn't the FTE calculation, but so it is 2:30. We absolutely are willing and excited to take more questions. We do have Maner at manercpa.com, where you can always send questions in, and we'll make sure somebody reaches out to you, as well as the link to our online resource page. And I think we put that in there, but I will go ahead and do that again just to make sure that everybody has it. Jim or Shane, would you like to say any last comments on how any questions, anything that we didn't cover that you just wanted to get out there? Jim, you want to go first?
Yeah, I have something, and I'll try to be quick about this. This is a planning opportunity for 2021. So for the employer or the employee retention credit for 2021, the reduction in gross receipts is it's a 20% reduction in 2021. So it's an easier threshold to meet. And also we have the benefit of foresight in being able to see that we know that now the PPP draw 2, you can elect a 24-week covered period. So thinking about that, when you get your draw 2 for your PPP loan, assuming you get one, if you still want to be able to take advantage of the employee retention credit, just remember that, to utilize the wages towards the end of the quarter or the end of the 24 weeks so that you can maximize your employee retention credit for the first and second quarter of 2021. So that's just a planning opportunity. It's now that we know what's going to happen, we can plan for that.
Perfect. Shane, did you have anything you wanted to add? And I did put up our contact information as well.
Jim brought up a good point, so I'll kind of piggyback off of his a little bit. For 2021, the credit is going to be 70% of up to $10,000 per quarter. So it's a lot more lucrative than what it was in 2020. You can actually get $14,000 per employee. There's also a safe harbor in place for determining eligibility. You can look at the preceding quarter and compare that back to 2019. So if your gross receipts for quarter 4 of 2020 were reduced by 20% or more compared to quarter 4 of 2019, you were already eligible for quarter 1 of 2021. So you can begin to plan for that a little bit. If you don't meet that safe harbor, it would just be the 20% reduction for quarter 1 of 2021 compared to quarter 1 of 2020 or 2019. So can still compare back to the corresponding quarter, or you can look at the preceding one to determine eligibility for 2021.
Perfect. What a way to end on a Friday afternoon. As we said, thank you very much for joining us today. We're certainly open to more questions. If anybody has them, our contact information should be at the bottom of your screen if you want to contact any of the 3 of us directly. Questions are always welcome at maner@manercpa.com as well. And I did also put the link to our resources page in the chat. But thank you all. Have a great Friday afternoon and wonderful weekend. We will be in touch.
Thank you.
Thanks, everybody.